Okay, we're going to talk about bad debts. Bad debt can be a difficult thing for some students, so if you're having trouble with it, hopefully you'll watch this video and work through a couple of problems, or several of the problems, or many of the problems until you get it. I would suggest that you write this on a sheet of paper. There are two overall methods to account for the bad debts. The first one is the direct write-off method, and here's your entry for the direct write-off method. We'll come back to that in just a second. And then the second one is your allowance method. And the allowance method, there are I should have four here. There's really only two. These are going to reverse them. So there's two methods for that. Okay. Under the direct write-off method, when you have a person that goes bankrupt, or you can't get a hold of them, or you figure out they've passed away or something, and you figure out they're not going to pay your bill. So remember, when I recorded them as a sale, I debited accounts receivable and credited sales. And so let's say that they owed $100. So there was my journal entry. So notice it hit revenue right there. That's where it hit the revenue, because sales is a revenue account. So it's in my revenue account. And they don't pay. So let's say they filed bankruptcy. So I'm never going to collect on an accounts receivable. So what happens when that person goes bankrupt under the direct write-off method? I debit bad debt expense and I credit accounts receivable. So you can see in this case, if it was $100 that they didn't pay their entire bill, I have revenue of $100, and then I'll have bad debt expense of $100, so my net income is zero. So it goes through my income statement, both as a revenue that I did make the sale, but then that they didn't pay it off. So my income is zero. Okay. The problem with the direct write-off method that you need to know is it is not GAAP. Okay. The reason it is not GAAP is because GAAP follows the matching principle, and the matching principle says the expense has to be recorded in the same year as the related sale. So notice the entry I didn't make here is cost of goods sold and inventory. And so notice that generally speaking, we debit inventory when we buy it, and then when we sell it, we make two entries, one to record the revenue and then one to record the related expense. So if the cost of goods sold is 60 and came out of inventory, then my gross profit on my income statement is sales of 100 minus cost of goods sold of 60. So I made $40 on this. All right. So then that all happens in the same period, and in fact the same day, unless you're using periodic. But under perpetual, it happens on the same day. However, what if this person never pays me? And so if this person never pays me, I'm going to have sales. I'm not going to type out the words because I'm a horrible typer. But anyway, I will have sales of 100, and I will have cost of goods sold of 60. Okay, and then if this person doesn't pay me, they owed $100. So I'm going to have subtract out $100. And notice what happens. My net income is now technically a loss of $60. Okay, because I have my revenues of 100, my cost of goods sold of 60, my bad debts of 100 because they didn't pay. So I've lost the $60 because unless I can go back and get my inventory and resell it, I'm out that $60. So that's what my income statement is going to look like. Sales minus cost of goods sold minus bad debt expense equals net income of 60. And I just didn't want to type out the words. Okay, so the problem comes in with the matching principle, because if I made this journal entry in December and this person didn't go bankrupt until the next year, I'm going to have my sales and cost of goods sold in 1 year and my bad debt expense in the next year. So that's why it's not GAAP, because it violates the matching principle. So make sure you know that. It is not GAAP because it violates the matching principle. There is one instance where it could be GAAP, and that's if sales are so immaterial, sales on account are so immaterial. So if a business mainly had cash sales or credit card sales, so it didn't sell on account, then you wouldn't have very many bad debts. So a lot of small stores would not sell on account. So if you would go into a small boutique downtown Quincy, you could probably use a credit card and you could probably use cash, but they wouldn't let you take the outfit out the door and pay later. So if for that case, bad debt expense would be very minimal. If you recall from a prior chapter, credit card sales are cash because it's the credit card company that bears the risk of loss, and they generally charge the store to make the sale on account. So that's the direct write-off method. So let's make this journal entry. So journalizing the following transactions using the direct write-off method. So make sure you notice those words, direct write-off method. Because later on we'll say we wrote off an account right here, to write off an account. So make sure you direct write-off method. You are looking for those, is that 4 words? Is that 1 word or 2? You're looking for those words. So we received $275 from Sean McNeely and wrote off the remainder owed $1,000 as uncollectible. So previously we must have had an accounts receivable from this person of $1,275. So this entry was made. No idea what the cost of goods sold entry was. It's sort of irrelevant to this chapter, so they generally don't make that journal entry, so I'm going to delete the thing, but it's still important because of the matching principle here. All right, so I got $275 from him, so I'm going to debit cash and credit accounts receivable. I'll show you in a second. And I wrote off the remainder. So here's how we write off an account. I put it into bad debt expense and take it out of accounts receivable. So it's pretty important to make sure that you understand that you write it off of the account, because that person is no longer an asset. Accounts receivable is an asset. If that's not, person's not going to pay you, you can't leave it on as an asset on your books. However, that person's name gets sent down to the credit department and you work harder on their account down there. It's just that you can't leave it on your books as an asset. So when you write off their account, that doesn't mean you forget about them. In fact, you worry more about them. They're just not on your financial statements. Okay, so this is the journal entry. So I debit cash for the $275 that I got. I debit bad debt expense for the portion they're not going to pay. And then I credit accounts receivable $1,275, and I send Sean McNeely's account down to the collection department, and they start trying to collect from him or get the inventory back. So anyway, so it's out of accounting into the credit department. Then I reinstated the account of Sean McNeely and received $1,000 cash in full payment. So basically what happens is this entry was wrong. I shouldn't have done the debit the bad debt expense and credit accounts receivable. So for the $1,000 part of this entry, I just flip it. So I credit bad debt expense to get it out. So if you think about it, draw a T account of bad debt expense. I debit it for $1,000, credit it for $1,000, so it's no longer on there. And I put the accounts receivable back on my books. So I flipped the part of the entry that was wrong, and then I showed I collected cash on accounts receivable. So I debit cash, credit accounts receivable. So that's the direct write-off method. Thus its name is you write it off directly to accounts receivable. Okay, so let's go back through the other method for a second. I'll pause it. Okay, so under the allowance method, we're going to focus on these two entries right here. Under the allowance method, in order to not violate the matching principle, I have to get my bad debt expense in the same year as I made this sales entry. And there's only one way you can do that, and that's to guess. So what I'm going to do is, based on past experience, I'm going to look up some trends for how much I collect on my sales. If you start your new business this year, if you opened it up in January, most accounts receivable are due in 30 days. So you do have some history of seeing, okay, how many people that I sold to in January paid? How many people have I sold to in February paid? Et cetera, et cetera. What percentage of them went bankrupt? Which percentage of them didn't pay? So you do have some methods to guess, even if it's your first year, but you keep track of all that, and so you're going to get an estimate of how many people won't pay. And that estimate is in this journal entry. So I debit bad debt expense. So notice it's the same as this one. But I don't credit accounts receivable because I don't know the name of the person who isn't going to pay. I just know that 10% of the people aren't going to pay or 5% of the people aren't going to pay. Okay, so notice this is my estimate. So I credit what's called an allowance for doubtful accounts or allowance for bad debts. So if I made a T account of accounts receivable, and my accounts receivable, my accounts receivable is an asset, okay, and so I have, there's my, not a very good T account, but it's the best I can do here. Okay, so there's my accounts receivable. Okay, so my accounts receivable, let's say for the whole year, is $10,000. Okay, and I have made, I'm going to copy this thing. Then I'm going to have another account called the allowance. I can type. Okay, and the allowance is going to hold my estimate of how much is not going to be paid. So let's say that my estimate is 10% of accounts receivable, and we're going to figure out, we're going to talk about this estimate in just a little bit. So I think that 10% of accounts receivable won't be paid. I don't know whose accounts receivable because there's a subsidiary ledger under accounts receivable that says Johnny owes him $100, Jill owes him $200, etc., etc., and all these customers add up to 10,000. So I can't credit accounts receivable because accounts receivable needs the name of a person attached to who's not going to pay. So I put it into a holding account. And notice that on the balance sheet, these two accounts will always be shown together. So I will say that the net realizable value of accounts receivable is the $10,000 minus the $1,000 in the allowance. So $9,000 is the asset value. The current or future benefit of this is $9,000. So these will always be shown together. One follows the other. You will never see an accounts receivable without the allowance, and you will never see an allowance without the accounts receivable. It is always there. So we will talk about the net realizable value. So accounts receivable will always have two accounts following it. All right, so now I set it up and I put it in here. So this $1,000 is my estimate, which we'll talk about in just a second how you come up with it. Okay, so then when I write off an account, so now I know it's Johnny's, okay? So Johnny has a $100 account and he went bankrupt. So now I can take it out of the allowance. So let's say $100. I can take it out of the allowance and out of accounts receivable. So now I know that what I have in my accounts receivable is 10,000 minus 100, and my allowance has 900 in it. And so now, if you look at this real quick, so let's total that up. $9,900 in my accounts receivable, and my allowance has 900 in it. So look at my net realizable value. Your net realizable value is still 9,000. And the reason is because this $1,000 before had the estimate of how many aren't going to pay, and now when somebody doesn't pay, you just apply it toward that estimate, okay, which is already done. So the net realizable value always stays the same after a write-off. So one thing I want you to pay attention to, so these journal entries, I'm going to color them a little different. I'll color them green here. Okay, they're kind of different. We'll get to those in a second. I want you to look at this. Notice this one is always in the year of the sale. Okay, that if we make this in the year of the sale, then I can match it with my sales. Okay, so and this one is done whenever they write off the account. Notice the direct write-off method does this entry whenever a debt goes bad, so it could be in the later year. But if you can remember, the direct write-off method doesn't have the allowance. And I'm going to copy this here. So if I take this and I copy it up here, okay, and I'm going to tell myself the direct write-off method doesn't have the allowance. I'm going to delete the allowance from those entries. Look what I'm left with. I'm left with debiting bad debt expense and crediting accounts receivable. So there you go. So the direct write-off method is simply the same sort of entry except the allowance method, except I don't have the allowance, and since I don't have the allowance, it's just simply debiting bad debt expense and crediting accounts receivable. The allowance method splits it up into 2 different years. Set up the allowance, your estimate, and then when you write off the accounts. So if I have a perfect estimate by the end of the year, if businesses just kind of sold everything in one day and then collected it or not collected it throughout the year, I made a $1,000 estimate. My balance in the allowance at the end of the year would be 0 because I'd have a perfect estimate. Now we're going to talk about that. You never have a perfect estimate. Sure would be nice. Okay. So the estimate is in this entry. Make sure you know that. This is the estimate. Always the estimate. So if you see something like estimate or something that implies the word estimate, that's this debit, this credit. Always. And when you write off an account, you're always crediting accounts receivable. Now, what happens if I write off an account and the person later pays, as in they did right here? If they later pay, I need to flip this entry. So just like I flipped that entry for the portion, I need to flip this entry. So notice I debited the allowance, now I credit it. I credit accounts receivable, now I debit it. And then show you collect the cash. So debit cash, accounts receivable, because I collect the cash. Okay, the last thing I want to talk about here is how you make that YY entry. Okay, there are 2 ways to make the estimate. And this is also important. But notice the journal entry is the same, it's just the amount is going to be different. So the amount, the 2 ways to do it are based on sales. And the second way that you're going to do it is based on accounts receivable. Okay? Pause this a second. There's 2 ways to make the estimate. One is based on sales. And so when you base it on sales, you look at the sales. You look at sales to determine the amount of bad debt expense. Okay? And when you do that, your bad debt expense will have a 0 balance. Okay? It'll have a 0 balance before the entry. So if you say, in this case, 10% of sales, so my sales are $12.75, so 10% of sales would be $127.50. Bad debt expense will always be a 0 balance before I make this journal entry because I just make it once a year. And at least in this book, some companies make it monthly, so it might have a balance. But for our purposes, it'll have a 0 balance. So I'll make $127.50 in it if it's 10% of sales, so this entry would be $127.50. The allowance just goes along for the ride. So if the allowance had $900 in it, I would just simply add the $127.50 to it, and then I would have my new balance. Okay? The second method is I look at accounts receivable. When I look at accounts receivable, I determine the amount. That word is amount. It just looks like among. Determine the amount to go in the allowance. However, the allowance may already have a balance in it. So for instance, I might look at accounts receivable and I determine that I want $1,100 in the allowance. My allowance already has $900 in it, so I need to add $200 to my allowance to get it from $200 to $1,100. So it's this number that differs, and we're going to do a few of those here. Remember, when I base it on sales, I just make my entry be the number, and when I base it on accounts receivable, I have to determine what I want the allowance to be and force it to that. Okay, pause. Okay, so journalize the following transaction using the allowance method. So I know it's the allowance method, so I know I'm going to have an allowance in most of my journal entries. So I received $275 from Sean McNeely and wrote off the remainder of the $1,000 as uncollectible. So notice on this one, the direct write-off method, I debited bad debt expense and credit accounts receivable. Here, I have to ask myself, hopefully you wrote down those journal entries I made on the second page, am I setting up the allowance or am I writing one off? And it says, wrote off. right there. It says no place that I'm setting it up. It says I wrote it off. So I need to go to my write-off entry, which I believe was the second one on that page. And I debit the allowance and credit accounts receivable. In this one, I also collected $275 cash, so you could make this in 2 journal entries. They do it in one. I debit cash for $275. I debit the allowance for $1,000, and I credit accounts receivable. Then I reinstated the account because he paid me $1,000 full payment. So I flipped this entry for the $1,000, credit the allowance, debit accounts receivable, and then I show I received the cash. Okay. Next one. Okay. At the end of the current year, the accounts receivable account has a debit balance of $2,950,000. I'm going to pause it. So I did the T accounts here. Accounts receivable has a debit balance of $2,950,000. Sales has $27,400, which is a credit, and the adjusted entry providing under the following assumptions. Okay, so the allowance account before adjustment has a debit balance of $9,500. Notice the allowance, generally speaking, has a credit balance when we're done with it. So if you look at that other page, I drew accounts receivable there. And accounts receivable had a debit balance, and the allowance had a credit balance because I believe I had like $10,000 here and $100 weren't going to be collected. Okay, so it generally has a credit balance. However, look at the other journal entries. Here's my estimate here. Okay, so I estimated $1,000 would be written off. That's $1,000. It just doesn't look like it. Okay, and so during the year, if you look at it, here's my write-offs. Okay, so right here, I wrote off this account for $1,000. And then if I reinstate it, it goes over here. So remember, I only do this allowance once a year. So if I have a debit balance, it simply means, in this case, I wrote off more than $1,000. Quite a bit more, in fact. But that was just my other estimate. If I have a credit balance, it means I didn't write off as much as I thought I would write it off. So I still have some of that money left. So it can, at the end of the year, debit balance, last year I wrote off more than I thought I would. Credit balance, I haven't written them off yet. In reality, wish I hadn't done that. In reality, since we sell and collect on sales every day, sometimes the debit or credit balance is just a timing difference of not having written off anything yet. Okay, so I am going to put at least the allowance back up there. It's a little bit frustrating. Okay, so the allowance has a debit balance of $9,500 in it. That's the one I care about. Okay, and we're estimated to be 3/4% of sales. Okay, so I have sales of $27,400,000 and 3/4%. So you can be 0.01 is 1%, so 0.0075. So the question is, do I care about this allowance? So let's think about our journal entry. And our journal entry is, in this case, I need to ask myself, am I setting up the allowance or am I writing off an account? And I see that my allowance, I'm estimating. So right there, when I see the word estimating, I'm setting up the allowance. So I'm going to debit bad debt expense. And I'm going to credit the allowance. I can get it down there. This is a little bit hard to use. Okay. Isn't that a great journal entry? I think I even... Okay. So that's my allowance. There's my credit. Just doesn't happen to be. So my question is, what goes in my debit right here? What amount goes here, and what amount goes there? Okay, what's my debit? What's my credit? Okay, so in this one, I'm basing it on sales Bad debt is sales, right there. So if it's sales, I do not care about this 9,500. I simply make whatever my computed entry is. So my journal entry is 205,500, and that journal entry is there too. So I'm going to notice that's my credit to my allowance. I'm going to add 205,500 to my allowance, and my allowance is now $196,000. Okay, if I wanted to know what is the net realizable value of my accounts receivable, I'd look at my accounts receivable. Gee, it would have been nice if I would have kept that up there. And my accounts receivable has a debit balance of $2,950,000. And my allowance has $196,000 in it. That's just a great 6, isn't it? Okay, and so my net realizable value is the $2,950,000 minus the $196,000. That's my net realizable value. Okay, next one. The allowance before adjustment has a debit balance of $9,500, so I still have that. Bad debt expense is an estimate of, an aging of accounts receivable on the customer ledger indicates an estimated doubtful accounts of $188,000. Okay, so this one is different than the other one. So if I can, hold on, pause this here. Okay, so I still have the debit balance of $9,500, except I'm using the accounts receivable method. So under the accounts receivable method, I still have the same debit and credit. So my debit is still bad debt expense, and my credit is still my allowance. Okay, so pretend that's spelled right. All right, so the question is, do I care about this debit of $9,500? And the answer is yes, because I am using the accounts receivable method. And under accounts receivable method, I am looking at accounts receivable, which is an asset, to determine how much goes in the allowance, which is a contra asset. So what I want in here is I want $188,000 in my accounts, in my allowance. Okay, so if I'm starting with a negative $9,500 and I want it to go to a positive $188,000, you can see that, maybe you can't see, where is B? Oh, there's B. Sure don't see the number there. Maybe it cut off because there's your check figure right there. So if I take negative, if I'm starting in the hole with $9,500, so I got to come out of the hole, 9,500 plus 188,000. I have 197,500. So your journal entry right here is going to be 197,500. Okay? Oh, I guess it's right there. Strange. Didn't copy very well. Okay? So there's B, 197,500, which is the 188,000, but I've got to come out of the whole 9,500 and add on another 188,000. So my journal entry right here to debit bad debt expense and credit my allowance is 197,500. If I wanted to figure out my net realizable value of accounts receivable, I'd take my 2,950,500, whatever that is, 2,950,000 minus my 188,000. That'll give you your net realizable value. C, the allowance for account before adjustment has a credit balance of 31,400, and bad debt is estimated to be 1% of sales. So let me clear all this again. Okay, and now I'm going to get my allowance out here. And I've got my allowance, and I now have a credit balance of 31,400. Okay, and so I'm not going to make the journal entry again, but the journal entry is to debit. If you look at it, I'm setting up the allowance. So all 4 of these, your journal entry is to debit bad debt expense, credit accounts receivable. So the question is, do I care about this $31,400 that's in the allowance? And the answer is no. No, I don't care, because I'm basing it on sales. And for sales, I care what my entry is into bad debt expense, not the allowance. So there's my credit for the allowance, okay? So I'm going to just throw that number into bad debt expense, because bad debt expense starts out the year, it's at 0. So I want to add 1% of 1/2 of sales. So my sales are 27,400,000 times 1/2 of 1%. So that's 137,000. So times 0.005, 137,000. So I'm going to make my journal entry for 137,000. I'm going to add that to allowance, and I'll have the balance of my allowances, those two added together. Then the last one I'm going to do is the allowance has a credit balance of 31,400. I'm just going to cross that off right there. Pretend that never happened. Pretend that never happened. I still debit bad debts, credit the allowance, but now I want an aging of the accounts indicates an estimated doubtful accounts of 175. That means I want 175,000 in the allowance, because when I look at, let me back up. When I do the sales method, sales is on the income statement. I'm determining how much I want to go into bad debt expense. Okay? Both of these are on the income statement. So some books call it the income statement method. When I look at an accounts receivable, I'm figuring out how much needs to go in the allowance, because one is an asset, one's a contra asset. Some books call it the balance sheet method. So now I care about the balance, so I want it to 175. So if I want it to 175,000, and I've already got 31,400 in it, so 175,000 minus 31,400. So I put 143,600 in the allowance. It's right there. Just sure. D 143,600. Just throw it kind of weird. All right. So that's that one. Again, in all these journal entries, I'm setting up the allowance. So every single one of these 4 has a debit to bad debt expense and credit the allowance. Just the amount changes on whether it's the sales method. I do it by the number computed, because I'm focusing on bad debt expense, which is 0 before I do the entry. If I do it on accounts receivable, I'm forcing the balance in accounts receivable and the allowance, the balance in the allowance to be 188,000. So I need to back into it if it already has a balance, just like we did supplies in chapter 4. If it can be a debit or credit balance in the allowance, and that can affect my journal entry. Okay, the last one I'm going to do on this video is we want our entry for bad debt expense under the direct write-off and allowance. So we had the following accounts receivables uncollectible for the year. So these people did not pay. The company prepared the following aging schedule for its December 31st. Journalized the write-offs under the direct write-off method. So we need to get this figured out what these are. And notice these are the actual people's names. When you have an actual person's names, this one is the write-off. And this one, notice it says estimate right here. This is the estimate. So if you flip it and look at your paper, this one is going to, the write-off entry debits the allowance and credits accounts receivable, because I know the people's names. And your estimate debits bad debt expense and credits the allowance. And again, I credit the allowance because I don't know who it is. Okay? Now, that's under the allowance method. Under the direct write-off method, I simply kind of combine these, and I debit bad debt expense and credit accounts receivable. So under the journalize it under the direct write-off method, I debit bad debt expense for 102,500 and credit accounts receivable for the people's names. B, journalize the write-offs under the allowance method, assuming the allowance account has a beginning balance of 95,000 and the company uses the account analysis of accounts receivable. So if I made a balance in my allowance account, I have has a beginning balance of 95,000. They really should tell you if that's a debit or credit. So let me figure that out a second, just a sec. Again, they should have told you it's in 95,000. Okay, it's kind of irrelevant in the write-off entry though. And so notice when I write off an accounts, I debit my allowance and credit accounts receivable. So it's the exact same entry as up here as far as numbers goes, but notice I debit the allowance because I've already set up bad debt expense in the estimate. So direct write-off, debit bad debt expense, allowance method, debit the allowance. Okay? Then also under B, I need to journalize the write-offs. That's this one. I kind of wish they'd made this B and C. And the year-end adjusting entry. So notice in my allowance, which is right here, that had 95,000, I just debited it for 102,500. So now I'm going to draw a T account and figure out that I now have 7,500 on here on the debit side. I always like to make a T account. Okay, hopefully your writing is better than mine with the mouse. Okay, but I have a debit balance of 7,500, and I'm going to figure out what do I want in it. So I have this aging of receivables, so I have 715,000. This is my balance of accounts receivable, by the way. That's how much accounts receivable I have. 715,000 aren't even due yet, and only 1% of those will go bad. 2%, as they get older, the chance of them going bad will be pretty high. I've seen some that are 100% because the client may write off all accounts over 180 days old. After the 6 months old, they automatically write it off. But they do one of these agings to identify that as 100%. Then they'll go ahead and hand this to the person responsible for writing them off, and they'll go ahead and write them off. Okay, so anyway, this is just their estimates they've got on past experience. So I take each of these numbers times the percentage, so you can see that. Each of those numbers times the percentage. Sometimes I just even write an equal sign right outside of this and put a little multiplication sign there and just have my little thing there. So if I add them up, I think 109,650 are going to go bad. So remember, I have a debit balance of 7,500 here. I want it to be a credit balance of 109,650. Okay, so how do I get from 7,500 in the hole out of the hole by 109,650? I have to add 117,150 to it. So I would go ahead and make this, oh there it is, a debit bad debt expense and credit the allowance. So notice that is your entry for the estimate. And all of these were estimated. So now I'm going to ready to start another year. So this one will have 117,150 in it, and I'll write some off, and then I'll do it again. Okay. Looks like we have a C in there. How much higher or lower would their net income have been under the allowance method than under the direct write-off method? And notice that under the direct write-off method, we had 102,500 of expenses, and under the allowance method, our expense wasn't 17,150. So the difference between those two is 14,650. Okay, and I'm not going to do that one in this video. Okay, but notice these are I'll give these to you in class, or have given them to you in class, and on Moodle the solutions are attached. So you can make some notes on it, but I would suggest you write them out yourself.